However, that same portfolio, and I hope to make that point clear, over the long run, let's say cash 20 years from now, that is being eroded by inflation and by currency changes. Because as we will see, all our consumption baskets consist today of a variety of goods. While we pay for them in Sing dollars, they're not priced in Sing dollars. When the euro goes up, and you want to replace your BMW, that BMW costs you more. You pay in Sing, but more. If the yen goes down, your Japanese car will probably, after a while, cost you less, at least on the parallel import side, because in terms of Sing dollars, the Japanese yen is less. So while we spend all our money in Sing dollars, there's many currencies that drive the price of the stuff that we buy, and therefore currency risk is always present, no matter that you say, I don't take any trips abroad, which of course Singaporeans do frequently. So there's another issue, and that is, according to this principle of diversification, when you invest, let me go back. When you invest in equities, for example, the question is, how do you structure your portfolio of domestic versus foreign equities? And the principle of diversification says that you should add, theoretically, a large part of your equity portfolio should be foreign securities. Actually, the smaller a country you live in, the more equity portfolio, the more foreign equities should be in your portfolio. And here I found a study, the numbers are a bit cumbersome to push, but it's possible. But here I found a convenient study that did that a few years ago for European investors. It says essentially that an investor in the Netherlands should have equities 15% local and 85% international, which means outside of the Netherlands. In Germany, you will say, oh, well, this is based on the past performance, but you will see if you drop down in the last section. Even for US investors in a very large country, as you know, they should have only 50% in local equities and 50% in equities outside of the US. Now, what is the reality? If I ask you, and you don't have to answer, I would say Singaporeans have most of their equities in what? In local equities. Why? Because we feel comfortable, right? Buying the normal blue chips, we all suffer from Singtel, and from them we know their strengths and weaknesses, so it's a convenient thing and comfortable thing. Of course, for Singaporeans, think about to invest in Singapore shares from a diversification and risk standpoint doesn't make any bloody sense at all. For a very simple reason, because most people tend to forget that the biggest asset they own tends to be what? The house and the job, even more, right? If you discount all your future expected income from your job, you are very heavily exposed to Singapore, because what happens when a recession hits? Well, the 97 is still within memory, right? Although the memories are now fading. And we know what happens during those years. First, CPF gets cut, and now we have flexible wages, right? Wages are cut, or we have to get a taxi license, or whatever else happens during a recession. And that means all of us are heavily exposed to Singapore. What happens, however, to your equity portfolio of Singapore shares during the very same period when your income from your job goes down or disappears? To ask the question means to answer it. It also goes down. So that means especially savers in small countries should have a large part of their savings outside of that country. That's a basic, very basic fact. And remember, you know, I don't know, unless you work for them or you have a cousin for them, even about Singapore, while the names may be familiar, you don't know the information before the insiders either. And in a reasonably efficient market, and the Singapore market is not bad, it's been well controlled, it's been well supervised, and almost, well, bad apples come up again and again, but nevertheless, by and large, the market prices here reflect information quite well. There is not much to discover unless your cousin works in a company which fudges its books and he or she tells you before they act on their own. In any case, there is probably no information in here. Here again is the summary of what I just said. Numbers like these are based on the pure models of Markowitz Sharp. Those are the two authors in 30 years ago who created that stuff. On portfolio diversification, however, that leaves out the fact that most people have their biggest investment in their local job and local business. And obviously that goes down. So the question is, I want to have at least my savings in assets that have a low correlation with my local firm. And that, ladies and gentlemen, is not Malaysian counters either. We have to go, let me go right into the correlation issue. Historically, cross correlations between markets, between major markets, have been relatively low, about 0.5%. That means if one market goes down, the other market goes down, but only by about half of that. That's what cross correlation simplified means. Here are some historical numbers. You can get them. Academics love to crunch them, and I know my colleagues in the investment courses at NTU thinks it's a great learning device for their students to crunch these numbers. So they come up with new numbers every semester. And the problem with these correlations is, of course, and here is one of the most recent research papers that I could find. It's about a few months old, where two well-known people from Colombia, Beckert, Hodrick, and Chang, examined international stock returns co-movements using country, industry, and country-style portfolios. And using very refined statistical methods, which I don't want to bother you with, but I have confidence in their competency, and I think you can have too. They established the following stylized facts regarding international return co-movements. First, they find no evidence for an upward trend in return correlations, except for the European stock markets. Europe, if you have traveled to Europe, let's say 20 years ago, and in recent years, the Europeans really have coordinated and integrated their economy. The EU is a working thing while still in progress. The markets are very close. I remember still, when I went on my first internship to Paris, that was a long time ago, as a 20-year-old, I still had to waste half a day standing in front of the labor ministry, inside the labor ministry in Paris to get my working permit. Obviously that has long changed, and now traveling with a European passport, I can, if I can stand the climate there, and the taxes, I can work in 25 markets, 25 countries. Every EU citizen can do so. So that's a big advantage, and they have not only for labor, but for goods even earlier, integrated their markets quite successfully. Not surprising. Diversifying among European markets doesn't bring you anything. You can just simply buy one, and if you're comfortable with that, which for Singaporeans tends to be the UK, because you can read the language, that helps. That is sufficient. Secondly, the increasing importance of industry factors relative to country factors was a short-lived temporary phenomenon. We thought a few years ago, and I wrote a survey article myself, that said essentially whether the country diversification will still work is not so clear, because we get a global integration. Let's say all the paper companies in the world, all the food companies, all the chemical companies globally work in the same industries and have similar cycles. That was a short-term phenomenon. They all work today, move according to their national market.